Chapter 2, Part 2. Now we went through debits and credits. Now what we're going to do is journal entries and posting. So, overview of the chapter. We've already talked about what is a transaction, what is an account, types of accounts, and the debits and credit philosophy. Ground rules. That was Part 1. So if you don't know that, go back to Part 1. This is Part 2. We're going to do double entry accounting and record financial transactions along with posting them. That's what this part is going to cover. And then Part 3 is going to cover the trial balance and some examples. Now, debits and credits. Remember, you should keep this on a piece of paper while you're doing your homework. You increase debit, you use a debit to increase assets, dividends, and expenses. You use a credit to increase liabilities, revenue, common stock, and retained earnings. So, you need to memorize that. Normal balance, that's another thing. You got to remember the way you increase them is the normal balance. So, what increases the account? If the balance is not normal, it indicates a negative amount. Journal entries. We write the account debited first and the amount in the left column, and we write in indent the account credited next and the amount in the right column. Debits must equal credits. Now, this is what a journal entry would look like if we were doing our accounting manually. It would be in the general journal, and it's the what is considered the journal of original entry, because you see both sides of the transactions. It's always in chronological order. What does that mean? Every day as things go on, you record them. Okay, so remember, the initial transaction is recorded in the general journal. That should be recorded, not recoded. Let me fix that right now. Okay, I fixed that. The initial transaction is recorded in the general journal, again in chronological order, and is also called the book of record because it shows both sides of the transaction, which is what I just said. Now, when all this was done manually, you used to have to then turn around and post to the individual accounts. With computers today, the computer posts it to the accounts. You can get a printout of the accounts, but the computer is going to be posting. You enter the journals, and it posts them to the accounts. But you're going to have to do it manually. And what posting is, you're transferring the information in the general ledger to the general ledger, because it comes from the general journal. This is the general ledger, and what that shows is all the accounts and the financial transactions for each account. So if you wanted to know your cash balance, you would want to go to the general ledger. Now let's take a look at some transactions, and I'll show you how to do journal entries. So we're going to walk through all these transactions. We're going to record and post them, and I'm hoping by the time we finish, you're going to understand the rhythm of how you journalize, which you do through the whole semester. All right, we issued common stock for $50,000 in exchange for cash. First thing we need to always do whenever we have a financial transaction is identify accounts impacted by the transaction and what category they fall under in the accounting formula. So, in this case, we had common stock and we have cash. Common stock is stockholders' equity. Cash is an asset. The next thing you need to do is apply the debit credit rules for the increase or decrease in the accounts. First, you got to figure out, did they go up or down? Well, in this case, common stock increased because we issued out more stock, so it went up. And we received cash in exchange for the stock, so cash went up. So if you're looking at this, you notice we have two things, they both increased. Now, how do we increase them? Well, if it's common stock, we know we increase it with a credit. And we know if it's an asset, we increase it with a debit. And there is a journal entries. Now, When you do a journal, always show the debit first and then enter the credit. They must equal to keep the account equation in balance and are entered in the general journal again in chronological order. So our journal entry would be a debit to cash because it increased and a credit to common stock. Now, what would that look like when we posted it to the general journal? Well, we'd show cash that first. Now, normally you'll always reference the page and the date, because you want to be able to, if you go to cash, you say, wait a minute, where did we get that 50,000? You want to be able to track it back to the general journal to see both sides of the entry. So this is what it looked like it's posted. Now remember, in real life, this is done by the computer, but in this class, you're going to be doing that as part of your homework, but only in chapter 2, maybe in chapter 3. And then after that, you don't have to deal with these T accounts. However, you should always do T accounts whenever you're trying to figure stuff out. My suggestion. Now, the next thing we did is obtain a loan for $10,000, and we signed a note. So we know it has to be a notes payable. And in exchange, we got cash. So we gave them a note, they gave us cash. Notes payable is a liability, cash is an asset. What increased or decreased? Let's see. Notes payable went up. Cash went up also. We credit to increase a liability. We debit to increase an asset. Again, we're going to do the debit first. Remember the accounting equation. So we're going to debit cash. We're going to credit notes payable. Now we're going to post that to the general ledger. And there we go. Now you notice how I'm making sure I write them all down, because at the end we need to know how much cash we actually have. Now you can imagine when this was all done manually, the mistakes that people made transferring information from the general journal to the general ledger. I mean, you spend days trying to reconcile all this stuff. Now, we purchased office equipment on account for $30,000. Now, remember, whenever you see on account, what that means is we got something, but we didn't pay for it, which means we now have a liability. So, we've got equipment and accounts payable. Equipment is an asset, accounts payable is a liability. Now, increase, decrease. We increase the asset because now we have the asset, but we also increase our liability, accounts payable. We know that we debit equipment when it goes up, and we credit accounts payable when it goes up. And how do I know it went up? Well, we didn't have an accounts payable, and now we do, which means we went up. Now our journal entry is going to be equipment, accounts payable. Now, what does it look like when we post it? It's going to go to the equipment account and accounts payable. Now, we bought office equipment for $5,000, cash. So, we have office supplies and cash. However, we're staying on one side of the formula because they're both assets. Now, what's going to happen here is this, is office equipment went up, so we increased an asset, but cash went down, so we decreased an asset. So this is a wash on the asset side, because what we did is we moved the cash from cash to office supplies. Another way of looking at it. So we're going to debit office supplies and reduce our cash. Our journal entry would be we debit supplies, credit cash. And what does it look like when we post it? And then you should be doing this while you're looking at this, because you need this information for part 3. Okay, there's what it looks like in our cash account. Now, we received $25,000 in cash for services performed. So we got cash and we made sales. We have an asset and stockholders' equity. And cash increased and stockholders' equity increased. We're going to debit cash and credit sales. here's going to be our journal entry. And we're now going to post. Now, if you notice, cash seems to have the most activity, and that's normal. Cash and expenses tends to be where all the activity is. Now, next, we provided $10,000 in services on account. Now, what again that means is something happened, but no cash was exchanged. So, it would be accounts receivable because people owe us money. So again, we have an asset and we have stockholders' equity. Our accounts receivable went up and our sales went up. We increase our accounts receivable with a debit and we increase our sales with a credit. And here is our journal entry. And this is what it looks like in our chart of accounts. I mean, our general ledger, actually. Now, received an advance payment of $30,000. I hope this is helping you get in the flow of the thought process, which is always what was affected. These are the accounts. Now, this is different because normally we would think, well, this is revenue, but it's not, because what somebody did is they gave us cash in advance of us providing them any services. That's called deferred revenue. Deferred revenue is always a liability and it only appears on the balance sheet, is not on the income statement. Please don't put it there. Because we have received cash for services to be provided in the future. It is not treated as revenue until the service is provided and the revenue has been earned. So we have an asset and a liability. We're going to increase our cash and increase our liability. And there's our debit and credit. And our journal will be cash deferred revenue. And again, if you notice, our cash has the most entries. Now we paid the $20,000 on account for the equipment. Now remember, don't try to do this twice. Sometimes what people do is and then they try to do cash and equipment. No, you don't do that. What you want to do is you want to take the accounts payable off the books. You want to reduce accounts payable because now you don't owe the money anymore, but you also have to reduce the cash. So we're going to decrease cash and decrease accounts payable. Cash is a credit. When we increase a liability, it's a debit. And there's our journal entry. And now we can post it. And now we have only owe $10,000 instead of the $30,000 original because we paid $20,000, and that's how we could tell by going to that account. Now we paid rent of $4,000. It would be an expense and cash. Stockholders' equity, an asset. Rent increases. And in this case, rent is, when we talk about rent, remember, rent is the opposite as part of stockholders' equity because it decreases stockholders' equity. So if rent expense went up, we have to debit it, and then we have to credit cash because we used up our cash when we paid it. Now we paid for the current month's utilities. Again, we're going to go through this process. And remember, expenses increase with a debit. Now you see all of our cash activity there. And then our last entry, we paid dividends. Cash and dividends. Again, dividends reduce stockholders' equity, so we increase them with a debit. Remember that. And we reduced our cash because we paid it out. Now, the last thing you want to do is, now that we've gone through all of this, is this is what our general ledger would look like. We would have all these transactions. And this is what's going to appear in part 3.